Welcome to the Deep Dive. We are your shortcut to being well-informed, and today we're jumping straight into the Q3 2025 earnings call for On Holding AG, ticker ONON.
Yeah, this was a really big one. Results dropped pre-market November 12th, and the reaction, well, it was immediate. Highly volatile trading right out of the gate.
So the market definitely noticed.
Oh, yeah. It signaled pretty clearly that, management delivered what looked like an absolute blowout, really validated that whole premium brand story they've been telling.
A blowout. Okay, let's get straight to the numbers then. The bottom line first. Adjusted diluted EPS.
Came in at CHF 0.43. That's Swiss francs, of course.
Right. And consensus was what, around $0.33, down 34 US?
Exactly. So depending on the FX rate you plug in, that's a beat of something like 50, maybe even 60% versus what the street expected. Huge beat.
50 to 60%. Wow. Okay, that's not just like squeaking by.
Yeah.
That sounds pretty significant.
It really is. And look at the net income margin jump to 15.0%. Just compare that to 4.8% a year ago. That's some serious operating leverage starting to kick in.
Okay, big jump there. And did the top line support that? Revenue?
It did. Net sales hit CHF 794.4 million. So, almost $1 billion US. Consensus was looking for maybe $949 million. So they beat that by about $46 million.
Solid beat on revenue, too. And the growth rate?
Reported sales were up 24.9% year over year. But the really interesting number is the constant currency growth.
Right, stripping out the FX noise.
Exactly. And that accelerated to 34.5% year over year. That shows you the underlying business momentum is really strong.
34.5% constant currency growth.
And you saw that flow through. Adjusted EBITDA was up almost 50% year over year, hit CHF 179.9 million.
Which pushed the margin up.
Pushed the adjusted EBITDA margin to 22.6%. That's 370 basis points higher than last year, 3.7% better.
Okay, those are some seriously impressive headline numbers, but numbers need a narrative. What was the story from management? How did Casper Capetti frame this?
Yeah, the message was super clear. Capetti called it a true showcase of our premium strategy in action. They kept hammering that point, aiming to be the world's most premium global sportswear brand.
Explicitly setting themselves apart from discount-heavy players.
Exactly. They're saying, we're not playing that game.
Okay, but that brings up the obvious question, especially now. Pricing power. They did raise prices back on July 1st, right? Did that actually stick? Or did it slow things down?
Well, according to management, it absolutely stuck. They said customers, particularly their more affluent base, did not slow down buying our products.
Really? Even with higher prices?
Even better, actually. They noted the share of full price sell-through actually increased. So they raised prices and sold more stuff without discounts. That's a pretty strong validation of the brand's pull.
Okay, that is strong. So the brand's healthy. Where's the growth coming from specifically? You mentioned strong underlying momentum.
Right. Two main engines really stood out. First, geography. APAC, Asia Pacific.
Oh, okay. How'd that do?
Sales there just surged, 94.2% reported growth. But get this, constant currency, it was 109.2%.
Wow, over 100%.
Yep. And that's the fourth quarter in a row they've had triple-digit constant currency growth in APAC. The region's now getting close to 20% of total sales. It's a huge driver now.
Okay, so APAC is one major engine. What's the second?
Diversification beyond just shoes. Footwear grew, don't get me wrong, up 21.1% reported, which is solid.
But the other categories outperformed.
Massively. Apparel sales grew 86.9% reported. That's actually over 100% in constant currency.
100% growth in apparel.
Yeah, and they hit a milestone, sold over 1 million units of apparel in the quarter for the first time. Accessories grew even faster, up 145%.
So they're really pushing apparel as like a separate business almost.
Kind of. Management talks about it like a higher margin company within the company. They're clearly using the footwear brand Halo to expand, maybe take on players like Lululemon and that premium activewear space.
Interesting. Okay, now we have to talk about that gross margin, 65.7%, up 510 basis points year over year. That sounds almost too good to be true. Was there like an asterisk there?
There definitely was some nuance, and you have to, read the fine print. Management was pretty upfront about it.
Okay, what was it?
That huge 65.7% number included about 300 basis points, so 3 full percentage points of temporary benefits.
Okay. Temporary how?
About 200 basis points came from releasing some accruals they'd made in the first half because freight and some other costs came in lower than expected. And another 100 basis points was just a temporary FX tailwind from the weaker US dollar.
Got it. So roughly a third of that massive 5-10 basis point jump was kind of a one-off boost.
Yeah.
It feels like a pretty big asterisk.
It is significant context, absolutely. But here's the critical part, according to management.
Okay.
Even if you back out that 300 BP's temporary lift, the underlying sort of structural gross profit margin is still sustainably above their long-term target.
Right. So the non-temporary improvement is still substantial.
Exactly. They're saying the fundamental drivers of more direct consumer sales, better full price selling efficiencies, have pushed the sustainable baseline higher, even if 65.7% isn't the new normal every single quarter.
Okay, that makes sense. And that structural improvement must be what gave them the confidence for the raise part of the beat and raise. This was the third guidance raise this year.
Third time. Yeah, it's a pretty strong signal.
Yeah.
They lifted the full year 2025 constant currency sales growth target from at least 31% up to 34%.
Which implies
Reported sales around CHF 2.98 billion. They also bumped the gross margin outlook up to about 62.5% and the adjusted EBITDA margin outlook to over 18.0%.
And they didn't just raise for 2025, right? They gave a longer term update.
Yeah, that was interesting. They updated the 2023 through 2026 net sales KGR, target the compound annual growth rate.
Raised that too.
Raised it from around 27% previously to now at least 30%. That's a big statement about durability. It signals they think they can keep growing in the high 20s, low 30s for a while.
Implying still pretty strong growth needed in 2026 as well.
Right. Implies something like 23% or more growth still needed in 2026 just to hit that new target. They're projecting sustained momentum.
And they seem to be investing behind that. It's not just about the shoes anymore, is it? It feels like a broader brand play.
Absolutely. That brand heat is something they're actively cultivating. You see the new flagship stores, Palo Alto, Zurich, Tokyo.
Right, prime locations.
Plus, they highlighted winning their first World Athletics Championship gold medals that boosts performance cred. And importantly, the cultural stuff. Collaborations with Zendaya, with Burna Boy.
Reaching younger, maybe more fashion-focused consumers.
Exactly. Diversifying beyond just the serious runner crowd, building that cultural relevance.
Okay, and on the risk side, what about tariffs? That was a concern floating around.
Management sounded pretty confident. They basically said they can easily digest the tariffs with the current margins.
So no immediate price hikes planned for early next year.
Explicitly said no additional price hikes planned for early 2026. Their strategy seems to be hold the premium price point, but be really disciplined about not discounting, especially through the holidays.
Okay, makes sense. So incredible quarter, strong guidance, confident management. The market loved it. Stock popped almost 18%. Options volume went crazy, very bullish skew.
Yeah, 9 times normal volume, 4-to-1 calls over puts. Big reaction.
But here's the tension I see. Before this pop, the stock was still down, 20% from its yearly high, and lagging the consumer discretionary sector significantly.
Right. XLY was up like 23% over the year. Onan was lagging way behind before this earnings pop.
And Chartmill still gives it a technical rating of just 1 out of 10. That suggests there's still some deep skepticism, or at least a technically damaged chart, despite this great print.
That's exactly the tension. You've got stellar fundamentals this quarter, but a stock chart that looks, pretty broken long term. And valuation isn't cheap either, around 49 times trailing earnings after the pop.
So the market's asking, is this finally the turning point? Can it transition from a volatile story stock to something more durable?
That's the multi-billion-dollar question.
Okay, perfect time to transition then. Let's talk about our segment. This is not financial advice.
Disclaimer, fully noted.
Right. So we have this amazing momentum, the raised 30% long-term growth target, huge bullish options flow. But that valuation, that weak technical picture, feels like a setup for something bold.
It does. And you look at the average analyst price target out there, still around $61.60. Even after the 18% pop, that implies, another 48% upside potential?
Almost 50% more upside baked into analyst targets.
So if you believe the story and you believe it can break that technical resistance, you need a way to capture that significant potential upside.
So what's the outrageous but plausible trade idea here?
Okay, here it is. You could look at buying a call option, but give yourself time, say 9 to 12 months out to expiration.
A long-dated call.
Exactly, and maybe one that's significantly out of the money right now. The premium will feel high, maybe even outrageous, but that's the price you pay for that potentially large upside exposure.
So you're betting the stock not only recovers, but actually surpasses that average analyst target of $61.60 sometime next year.
That's the bet, but it's definitely contingent on a couple of things happening.
Like what?
First, they have to execute on that full price discipline through the holiday quarter, Q4. No caving to discount pressure. Second, Q1 2026 earnings need to prove that the higher structural margin is real and sticky, not just a blip helped by those freight cost reversals.
The proof points needed on discipline and margin durability.
Precisely. You're essentially betting that the 30% long-term CAGR is legit and that eventually the fundamentals will win out over the current technical weakness. It's a bet on the story truly maturing.
High conviction, high risk, potential high reward. Got it. Okay, let's wrap up this deep dive. Key takeaway. Omanon delivered a massive beat and raise. Seems like validation for the premium strategy, pricing power looks strong, and growth, especially in APAC and apparel, was just phenomenal.
Yeah, the quarter itself was hard to fault. Which leaves us with the final provocative thought for you, the listener. With that long-term growth target now boosted to 30%, can ONA actually convince the market it's shifted from being this, volatile story stock that's often under pressure into a more durable, maybe even luxury-like compounder?
Or do those macro worries, potential tariff impacts down the line, or just plain old execution risk ultimately put a cap on this rally before it really breaks free from that technical damage?
That's the debate the market's having right now.
Indeed. And remember, as always, this discussion is for informational purposes only. It is definitely not financial advice. Thanks for diving deep with us today.